Modiv. To tell us a little bit about the world of real estate, could you introduce your company to our audience who may or may not be familiar with it?
Hey, Nicole, thanks for having me. Greatly appreciated. Yeah, so Modiv is a unique company. It's commercial real estate investment, net lease assets, so long-term single-tenant properties. But unlike some of the other similar REITs out there like that, we were fully raised by crowdfunding, so direct-to-consumer model. We are the first crowdfunding company to have a publicly traded security. About a month ago, we issued a preferred security on the NYSE, and we're the largest equity REIT raised by form of crowdfunding. So we buy real estate, we provide a monthly dividend to our investors, and we just keep focused on providing the benefits of commercial real estate to individual investors.
And people who look at commercial real estate, I mean, we always thought of real estate as a real safe haven, a defensive play. Even today, it's one of the best performing sectors. Real estate's exciting because it, obviously adds value, pays dividends. There's usually growth over time. It always seemed like a no-brainer, particularly for anybody in business or investing. At this time, it's been a little different because COVID was a little different. But how about going forward? You still think everybody should have some real estate in their portfolio, right? Why?
Yeah, so if you're right. I think everyone sort of is very familiar with real estate. If you think about it, it's in a way first nature to us. We live in it, we work in it, we shop in it, we get taken care of in it. We all are around real estate all the time. We have an intuitive first sense to us. Going back to the years of the robber barons and the John D. Rockefellers, we've always associated owning real estate with wealth. And that hasn't changed. But why would you continue to own real estate even if the markets run up and we have a lower interest rate environment? So long-term investing principles, sort of the Yale endowment model, or what you see in any of the pension plans, is they always tend to allocate some percentage of their portfolio to private commercial real estate. Why? Well, for the primary benefit of diversification, right? So when our equities are flailing all around, or our bonds are off, or whatever, it provides a diversifying return profile. That steady income is a big component of that, but it's also just the nature of how real estate is a longer cycle event. So it doesn't get priced as easily, doesn't get priced as readily, and therefore it provides a balancing act to a portfolio. When we go out to individual investors, we really encourage them to have a small percentage of their portfolio within their comfort levels in a real estate class that they wouldn't otherwise be able to buy. Because a $30 million property is really hard to buy unless you're buying it through a share vehicle.
So these clients, right, that we're seeing that are so Costco, 3M, Walgreens, what is it when you work with these companies? What is it? What's your relationship with them? And of course, when we talk about leasing, long-term leases have the beauty of really being less susceptible to volatility.
Right. So if you think about the real estate market, right? So the income is generated from rental income or leases, and you have the shortest lease durations, which are hotels, which they have a daily lease, right? So I come in for a night. And we're on the opposite end of the spectrum, where we have 15, 20-year leases with some of these very high quality investment grade tenants that you mentioned. And our relationship with them is we're the landlord, right? So this is a particular location that they want to do business in, and we're the landlord of the property. But in a triple net structure that we use, it's basically like we're a bondholder. And what I mean by that is that these are types of landlords who they want to pay their the taxes, they want to pay the insurance, they're going to take care of their property, they're just going to pay you effectively the lease payment. Whereas if I owned an apartment building, I would be doing all those things, and the tenant would just simply be paying just the rent. And so net lease assets are very much like buying other types of investments. They have a long-term horizon. I think the key with long-term leases and the downfall of them is you need to have rent growth. So rent escalators and different contractual reasons why the rent will go up. Because if you had a 15-year lease that didn't have any increase in rent, though you'd have stability, you wouldn't have inflation protection. And so rent increases in long-term leases are a good combination.
Yeah, and you talked about how you got started with the crowd sharing, and now when people want to invest in real estate, what's your best investment advice at this point?
My best investment, I do a lot of these things. We're a direct-to-consumer model, so we're in social media, we're on YouTube, and I do a lot of videos on this. I think people need to be patient with the real estate sector, right? I caution people that it's not crypto, right? Real estate is a long-term cycle event. You know, loans, mortgages are measured in years, and full cycle events are measured in years. And it's a really solid income-producing type of environment. But when you get more and more speculative with your real estate investments, then you tend to get disappointed because reality doesn't always match your expectation. So I think I encourage people to be patient with real estate investments. It's done really well. It's done historically well over the long term, but it doesn't always become high flying. It is right now. The MSCI is up and IYR are up quite a bit for the year to date. That's a reflection of low interest rates. But long term, the hardcore real estate assets, they take longer time cycles. So I tell people to be patient. I also tell people, like with any investment, don't over allocate. Don't put all your eggs in simply one basket, because it might feel good when it's going up, but it doesn't feel good when it's going down.